We're now working on part A of this exercise. So this exercise, accounting cycle steps 1 through 4, we have a series of happenings, and part A is to prepare journal entries, and we're given a list of accounts. So I'm going to not show this on my screen anymore, but know that you need to have this list. I'm going to be referring to the transactions. The transactions are uniquely identified by dates. So that's how I will be referring to those dates. So I'm going to go into our Excel file. And again, we're just using Excel as a handy way to do our homework and to submit it. This would actually be done in computer software, but this is a nice proxy for learning. So the first transaction on July 1st is Hardy and several others invested $2 million cash in the business in exchange for 20,000 shares of common stock. So what we're going to do is we have to remember the rules of debits and credits. So in the printed review notes for this class, if I go to that section, let me go right here. Okay, so I'm in the printed review, the digital series. I'm in the accounting cycle step 2. We're combining step 1 and 2. 1 is identifying and analyzing transaction, and 2 is writing the journal entry. So what I'm going to be doing is I'm going to pick one account that's affected by this transaction, tell whether that account's increasing or decreasing, identify what type of account it is, asset, liability, equity, etc. And then I'm going to look in the table to see whether I should debit or credit it. So that's what I'm doing when I'm talking through this. That's how I'm knowing whether I debit or credit something. So let's go back to our worksheet, our exercises. And the first transaction is that they invested $2 million into the business. And we're recording the transactions from the standpoint of the business. So the first transaction, pick one account. Well, cash. The company is getting cash, so cash is increasing. So I can put cash as my account, and I know it's going to be for $2 million. So I can do cash for $2 million. And then the other account, and I know I'm going to debit it because I went through the table. Cash is an asset. Cash is increasing. To increase an asset, I debit it. Okay, now the other side of this transaction is clearly my credit. I know that. I don't even have to worry about doing the debit credit table to know that I have to credit, because my debits have to equal my credits. The other side of this is what's happening. Why is the company getting cash? The company is getting cash because it issued stock. So we're going to credit common stock. Notice that I indented. I typically just spacebar over 5 spaces when I'm doing this in Excel. And then something that's not hugely critical right now is I like to put a memo line, and a memo line just says, what's this transaction for, right? Okay, so that's our first transaction. Now, our second transaction is the company purchased office space for $400,000, of which $100,000 was applicable to the land and $300,000 to the building. They made a payment of $120,000 and a long-term note payable for the balance. So let's see. First off, what did we get? Land, right? We got land. Land is an asset. Land is increasing. I'm going to debit it. Okay? So next up, I'm just going to reveal this whole one. I did it in the background so I wouldn't have to be typing away, right? Okay, so the company also received a building. So it bought land and a building, and they gave us the value, $100,000 for the land, $300,000 for the building. Now, how did they pay for it? They paid for it for cash, so cash decreased. We credit cash to decrease it, so that's where the $120,000 came from. And then they signed a note payable for the rest. So that's the $280,000. And if I add my debits, they will equal my credits. And there's my memo line. Again, the memo line is not a big deal, but you do want to have it. July 10th, computer equipment was purchased for $12,000 cash. So the magic here of my spreadsheet. I'm going to debit equipment because equipment is an asset. It's increasing. I'm going to debit it. And I'm going to credit cash because we paid cash for it. And then I have that memo line. So that was pretty quick. Okay, next transaction, July 12th. Office furnishings were purchased at a cost of $10,000. We made a $2,000 cash payment, down payment, and then we said we'll pay the rest by the end of July or August, and the remaining balance on October 1st. So we didn't sign a note or anything. So let's see what that looks like. So let me reveal this. Okay, so office furnishings is an asset. It went up. So we're going to debit it, and we paid for it with cash and also accounts payable. We're saying accounts payable because we're not given any information. We did sign a promissory note. We can assume it's short term in this case. Okay, moving forward now. So our transaction on July 20th was to purchase office supplies from Staples for $1,300. So what's going on here? Well, office supplies go up. Now, office supplies is an asset because we have not used those supplies yet, so they're not an expense. And then we're going to credit cash because we spent cash for them. Our next transaction, July 25th, they billed customers for consulting services provided. So they did work. This company, Hardy Consulting, did work, and they billed their customers. So when we bill customers, that's accounts receivable. So accounts receivable is an asset. It's amounts that our customers owe to us, and that's $56,000. And then the credit is consulting revenue. We earned revenue because we performed services. So that's where that credit comes from. July 26th, we mailed Kent Interiors the first installment due on the account payable for furnishings purchased on July 11th. Okay, so we'll reveal this one. Okay, so accounts payable, we paid them the first payment, the second payment of $2,000. And so we're spending cash, so cash would be credited. Notice that our credits are always listed after our debits. And then why are we paying cash? We're paying cash to pay down the accounts payable that we owe. So we now owe less, so our liability decreases. To decrease a liability, we debit it. Okay. 7/27, the company received and paid the following bills: utilities and telephone. So let's see how we record those. Okay, so utilities expense $1,700, telephone expense $550. Expenses are debited. How did we pay them? We paid them with cash. Cash decreased. We're going to credit it, and it's for the total of those two. July 28th, the company paid $6,300 for employee salaries. So let's go over here to see how we did this. Salaries expense, an expense because the people worked, $6,300, and then cash for $6,300. We're crediting it because we spent the cash. Okay. July 29th, we received $31,000 from customers in partial settlement of the accounts receivable. So those billings that we did, some of the customers are paying us. So we're getting cash. So we are going to debit cash because cash is increasing and cash is an asset. And we're going to credit accounts receivable for $31,000. And then we get to the last item. They sign a letter of intent to provide services, but there's no measurable financial impact. Nothing's happened yet. We're just saying, oh, we're going to do this in the next year. So that is not a transaction. There's no entry needed. So that's it on part A.